Okay, this is the New York Fire Department Pension Fund investment meeting. Today is 9/18/2013. It's 20 minutes after 10. We're at the New York City Controller's Office, 1 Center Street, room 530, New York, New York. We get a roll call. Trustees, please.
Ms. Janice Hanna.
Here.
Mr. Larry Schloss.
Here.
Mr. Justin Holt.
Here.
Mr. Steve Custer.
James Levin, that's Steve Cassidy's proxy.
And Mr. James Levin.
Here.
Mr. Robert Ross.
Here.
Mr. John Kelly.
Here.
Mr. James McGowan.
Here.
Mr. John Farina.
Here.
Mr. James Lamanda.
John Farina has James Lamonda's vote.
Mr. Sean O'Connor.
Here.
Commissioner Douglas White.
Here.
By 10 full votes of a quorum, we can start a meeting.
Performance reviews.
So everyone should have copies of the quarterly report for fire. And before we go to page 9, just want to remind everyone for September, this is for the fiscal year and quarter end in June of 2013, which was a very good fiscal year, as you'll see in a moment. The quarter was mixed. It started out good until Bernanke started talking and entering the word tapering into our financial lexicon, and that caused great volatility in not just the fixed income and interest rate markets, but in all financial markets, including risky assets. Until then, equities, high yield, risky assets did very well. After that, interest rates went up. So interest rate sensitive investments such as treasuries, REITs, TIPS went down, as you'll see in a moment. But overall, if you turn to page 9, the results were quite good. The fiscal year results are in the second and third column to the left, and as you see, they're just shy of 12% ahead of the benchmark. Very good results, and the 3-year number is also over 11%. But you'll notice the quarter is roughly flatlined, and that's because of what you'll see in just a moment. The assets were valued at $9.2 billion. On page 11, and we'll go through this as an update in just a few moments with Larry on July. As of June, you see the asset allocation on top, and by far the obvious, as we've had for a while, as is in the asset allocation, is the U.S. equity portfolio, which is shown in green. And on the left, on the bottom, we show the overweights and underweights versus policy. And the three things I want to draw your attention to is on the left, green, we will overweight U.S. equity for most of the year, not all of the year. And in the middle, the light blue and purple, lavender, colors, whatever that is, that represent TIPS. We were underweight TIPS, we were underweight Core Plus 5, overweight U.S. equities. All three of those helped, as we'll show you in a moment. And that moment is now, because the attribution is on the next 3 pages. For the quarter, and this is an interesting page, while the results were relatively flatline, minus 7 basis points for the results and plus 7 basis points for the benchmark, so 14 basis points underperformance, there really is a very important allocation effect, meaning the overweight to U.S. equities, the underweight to Core Plus 5 and TIPS, for the most part, was the primary driver of adding 43 basis points in just a quarter. The underperformance of the management effect is mostly from private equity, and I'll show you also for the year and the 3 years. So if you turn to the next page, for the 1-year number, which was strong at just under 12%, again, the allocation effect was 89 basis points, very strong allocation effect, mostly resulting from the overweight to U.S. equity and underweight to the interest rate sensitive products that we have, Core Plus 5 and TIPS. Any cash that we have contracted, but those other, and cash was minimal, but the over and underweights that we had added value. In addition, not only did the overweights and underweights in U.S. equity and Core Plus 5 add value, but the managers themselves, as seems as we go through the moment, in U.S. equity did very well, and Core Plus 5 did very well. However, the overall management effect is negative, 76 basis points, and it's mostly due to private equity. Private equity in a positive market environment with public markets generally lags because the marks don't get marked every day like the public markets do, so there is a lag effect. However, as you turn to the 3-year page, on the next slide, page 14, you'll see the negative management effect of over 1%, and that's mostly private equity. That's not now a lag effect. That is now simply underperformance in private equity. And the allocation effect over 3 years was mostly due to the cash that we held over that time in a strong market underperformance. So how did fire do versus?
I'm sorry, may I interrupt you for a second? I'm looking at page 15, and you said for 3 years that most of the underperformance was due to private equity, but it actually shows on page 15 that most of the underperformance was due to cash and short terms.
Okay, that's the allocation. I'm referring to the management effect. So,
Okay.
so for the allocation effect, yes, the cash over the 2 years ago and 3 year ago period did detract, and that's the minus 27 basis points.
Okay.
And that is the primary driver for the allocation effect underperformance for the 3 year period. But for the management effect on the next page, you'll see that private equity jumps off the page. It's not even close. And that's due to underperformance in the private equity portfolio.
Okay. And just for clarification, when you talk about overweights and underweights, they are still within policy. We're not outside of our policy weights. It is just you're just saying that we're at the high end of our policy range or the low end of our
Right.
policy
So we had set up U.S. equity to be at the high end and 4+5 to be at the low end and TIPS to be at the low end. Larry's going to show July when the market went back up, and we'll talk about that a little bit more.
Okay, thanks for
Before we go
clarifying.
through July. So how did police did great. How did fire do versus the other public funds? Yes. We measure that versus public funds greater than $1 billion. On page 17, the quarter placed you in the 55th percentile, just outside of the first quartile. And the 1 year number, it says 1188 to 1190, was also just outside the median, not the first quartile, the median. But you were ahead of the median for the 3 and 4 year and 5 year numbers. And going on even further, it gets better for 3 and 4 year numbers, as you see the blue dot in the bar charts. The numbers on an absolute basis were strong. And unless there are questions on that, I'm going to turn it over to Sue.
Okay, thanks, Mark. If you turn to page 21. This shows you your dynamic return versus the benchmark. So fire has about $3.5 billion, 37% of the total funds in U.S. equities. A couple things to point out here. Martin mentioned a couple things already, but you can see here in the quarter, a little bit of the benchmark, which is good. But importantly, if you look at the fiscal year-to-date numbers, first of all, the absolute numbers are very strong. U.S. equity markets up 23% for you guys, 21% for the index. So very strong absolute numbers. But the really good thing about fire's numbers is that the allocation that we talked about and the board approved, where we were overweight small cap relative to the benchmark, we were overweight mid cap relative to the benchmark, and we were underweight large cap relative to the Russell 3000. That helped a lot in this fiscal year. And also, importantly, the fact that we switched the Emerging Manager and Manager program from a all cap type mandate to now an all small cap type mandate, that helped as well. So just to give you a sense, so the small cap index was up 24%, the mid cap index was up 25%, and the large cap index was up 21%. So 300 to 400 basis points differential. So our overweights in small mid helped, and that's the allocation part of it. Then our active managers added value as well, which is really good to see, particularly in mid cap and large cap, where in mid cap, Fire's performance over the index was 200 basis points in excess. And in large cap, Fire's outperformance was 600 basis points in excess of the benchmark. So really good numbers for U.S. equities for Fire for the fiscal year. If you turn to the next page, we'll look at the U.S. equity breakout. This is for the quarter. So as you can see in the pie chart, about 75% of the money is on passive. And then I'll just point you to the 3 columns: index return, actual return, and the difference column. Like Martin mentioned, the U.S. markets were up, or positive, close to 3% in the quarter, and that's versus international, which had a much tougher time. Again, if you look at the difference column, you'll notice there that your active managers added value overall in the quarter. So that's good. So if you turn to page 29, go through international. about $1.5 billion. International equity is about 15% of the funds. And then if you look at the pie chart to the left there, you'll notice that it's quite the opposite from the U.S., where 80+% of the dollars are invested actively versus passively. And that's by design. And then if you look at the three columns, index return, actual return difference. As Martin mentioned, you can see here EFO is down about 1%, again, versus the U.S. being up close to 3%. And then you can see the emerging markets down nearly 8%. So a much tougher time, but longer term, we still think we're positioned well for growth in the emerging markets over time. And then if you look at the difference column, you can see there also that your active managers added value overall. So the next page is EFA. About 9% of the total funds, $850 million or so. And you can see in the quarter, behind the benchmark, particularly on the active side, a couple of managers had a tough time in the quarter. And in the fiscal year, you can see as well, so good absolute numbers, still lower than the U.S., but still nicely up, close to 19%. The U.S. being up 21% for the fiscal year. But you might remember that our new EFA managers were just funded recently, so they hit in May of this year. And so we would expect that those numbers going forward should look better. So if you turn to page 35, emerging markets. So here, about 6% of the total funds, close to $600 million. Again, in the quarter, we talked about down nearly 8% for the markets. Fire did a little bit better than that with the manager's performance. But if you look at the fiscal year to date, so you can see these numbers are a lot lower than what we saw in EFA and in the U.S. in the fiscal year, for all the reasons that Martin had mentioned. But if you look, the blue bar, that's your active managers, relative to the yellow bar, that's your index. About 100 basis points of outperformance relative to the index. Those are all your new emerging market managers adding value, which is good to see. We had a full year, calendar year of our new emerging market managers, so that helped for the fiscal year. If you now turn to page 37, we'll go through hedge funds. So we're at 3% of the total funds. We're working toward getting to 5%. So we're on our way. The trailing 3 months of the quarter, we had a tough time. We were going into a great quarter, and then June really hurt us, where we were down about 3%. But if you look at the fiscal year to date, that didn't hurt us too much because we still had strong outperformance relative to the benchmarks, but importantly, strong absolute performance. So we were up about 8.6% net. And we did this within all the targets that we wanted to do for the hedge fund program and have with respect to volatility and risk. So we achieved what we wanted. We'd always been targeting net 8 to 10% return, but also with a low volatility in the public equity markets, low correlation, and so we did that, which is nice. So we had a 0.14 beta to the S&P 500. We did that with a 4.5% volatility and about a 0.4 correlation to the S&P 500. So again, it's working well. We feel good about it, but we still have more to go. If there aren't any more questions, I'll turn it back to Mark.
If you turn to page 39, you'll see the total fixed income portfolio that represented 30% of Fire's assets, and the majority of that is in blue, which represents the 4+5. That's broken down on the following page, and you see that 17% of the assets are in the 4+5. I want to draw your attention to a few of the columns, the under and overweight. So in addition to being underweight the 4+5, we have been for a year or so underweight the government sector labeled treasuries agencies. If you look at either the index return or actual return column, you'll see that that was the worst performing sector, and we've been overweight the spread sectors, mortgages and investment grade credit. While the managers underperformed slightly, the fact that we were underweight the worst performing sector helped. And so if you turn to page 41, you'll see what the results were. We're not happy that they were negative results, We can't control interest rates, but we were ahead of the benchmark slightly by 6 basis points, returning minus 285. But if you look at the one-year return, the fiscal year-to-date return, it looks fairly measly at 32 basis points positive, but when you consider that the benchmark was minus 895, that's 127 basis points of outperformance. On an asset class that returned virtually nothing, having over 100 basis points of outperformance does help a lot. The 3-year number is still nearly 5%, also ahead of the benchmark, and the longer-term numbers are in the 5 to 6.5% range. And also the 1 and 3-year numbers are ahead, as I mentioned, primarily because of manager outperformance in addition to the underweight to the treasuries. Only 2 of the 11 managers underperformed. Both were government managers, and both were due to recent changes that occurred in May and June, and were only by a few basis points. So the program's done very well. For tips, it's on the next page. These are the lowest numbers that we have in fixed income. On the left side, you'll see the returns are minus 7%, while they were on top of the benchmark. The reason for this has to do with real rate duration. When rates go up, interest rates go up, prices of bonds go down. And tips have a very high duration, and so when interest rates go up even a little bit, tips can move. And in this case, because rates went up, tips moved downward. So fiscal year to date, while they were ahead of the benchmark, they returned minus 4.5%. 3-year number, they're ahead over 4.5% and ahead of the benchmark, despite the minus 7% in the quarter. High yield on page 43 had a negative quarter, mostly from the last few weeks of the quarter, and that return was minus 168. 15 basis points behind, but for the fiscal year to date, the returns were strong at 830, 69 basis points ahead. And for the 3-year period, 999, and for the 5-year number, also nearly 9.6%. And even 10 years returns are over 8%. So the high yield program, and also ahead of the benchmark nicely, so the high yield program has done very well. Larry, I think we'll talk a little bit more about that later. Convertible bonds. You have one manager here, which is Advent. Advent, we have 2 benchmarks here, yellow, which is the overall convertibles universe, and purple, which, I believe that's purple, which is the custom index, which represents the average of the managers, which is now Advent. And Advent beat their benchmark in all of the periods, and that's why you see the blue bar ahead of the purple bar, but it's below the yellow bar. Opportunistic fixed income on the next page, and we'll talk a little bit more about this in the executive session. It says it's 1% of the assets, it's really 2%. The returns were almost 4.5% ahead of the benchmark just for the quarter. For the year, over 15%, just under 10% for 3 years, and 12.5% for 5 years. I also want to draw your attention to the volatility on the bottom. While the benchmark is a 10% return, that's in yellow, we did adopt a secondary benchmark for purposes of looking at risk, and coincidentally or not, the risk, the volatility, risk as measured by volatility, has been very close to that of the benchmark, the secondary benchmark, the JP Morgan Global High Yield benchmark.
Hey Mark, I just have a question. Why is, on page 44, back to converts,
Yeah.
why is the custom index so different than the B of A index?
So, over the long term, remember we terminated the manager. So, long term, it was underperformance from a terminated manager. But what we've
Already talking about different indexes.
And indices, not our performance, but just...
Yes, so differences in the indexes is that the yellow index is the index that we adopted when we created the program back in 2008, and that was a benchmark that we felt was more comprehensive in the universe of overall convertible bonds. Each manager, however, has their own benchmark and fishes in the pond that's a subset of that benchmark. So over short periods of time, you will see differences in the benchmark depending on the volatility or the market cycles. But if you take a look at the 5-year number, the purple and the yellow converge. So over a market cycle, that's what we would expect.
Okay.
So what is the difference between the 2 indices?
Well, right now your manager is Advent. Advent is a defensive manager, so they have a more yield-oriented portfolio. The index, the yellow index, which by the way, over the systems we have 4 managers. None of those managers use that benchmark. The reason we chose it is because it's more inclusive, and the reason none of the managers manage to that is because what happens is in convertible bonds, they're very sensitive to equities. If the underlying equity that the bond represents drives up, the name in the index can go up to 5%, 10%, or even higher, and a manager will not manage a diversified portfolio owning that much of a particular name in the portfolio, especially when the delta becomes one-to-one with the equity movements. And so what happens is as performance of a particular name becomes stronger and stronger, it affects the benchmark in a positive way. In a bull market, it affects it in a positive way. But the managers, for diversification reasons, simply have to cut back. So the individual benchmarks are different, and they have been beating the individual benchmarks.
And what are they?
Yes.
What are the individual?
So for Advent, for FIRE, the Advent benchmark is something called the Merrill Lynch, Bank of America Merrill Lynch Yield Alternatives Index. And that's in the appendix. It's a benchmark that has less delta and more yield. Unless there are any other questions, I'm going to turn it over to David Morris, I guess, is it there? For ETIs.
David, brief, right?
Yes, very brief, I promise. Good morning. By way of introduction, my name is David Morris. I'm the Executive Director for the Bureau of Economic Development. As you know, Kathy Martino retired last month. Kathy worked for me, and structurally, our Bureau remains the same, operates the same, decision-making process remains the same. And of course, we have maintain a close relationship with BAM. I would like to introduce Chris Pack. Chris will be assuming Kathy Martino's role as the Director for Economically Targeted Investments. Okay, so in the past fiscal year, we beat our custom benchmark, and for PPAR, we had very positive returns, did very well. In the second quarter, we purchased $270,000 in loans to create or preserve 98 units. We also received commitments for over $561,000 covering 172 units. And the market value of the Fire Fund's PPAR portfolio is $2.13 million. By way of highlighting also, in the second quarter, we were very pleased to see the Emmis Fund make its inaugural investment in a commercial building in Brooklyn on Flatbush Avenue. The building was acquired for $17.5 million. There are 8 commercial units there. Tenants include the Carver Savings Bank, 7-Eleven, Blink Fitness, and AT&T. And this investment will preserve 22 jobs. Any questions? Great.
Thanks.
Nice to meet you all.
Just one question. You said this investment will retain 22 jobs.
22 jobs.
And what are the jobs?
They're positions within each of the retail tenants. And when the building is completed and rented up, there'll be more. So it's really based upon the number of tenants.
Who's they employ?
Yes, correct.
Okay.
Thank you.
Okay. So now going to the private equity quarterly report, starting on page 19. Excuse me, of your booklets. Just wait till you guys get there. So it's 19. So this is the quarterly report for the ending the first quarter of 2013. So if you look at the table at the middle of your page, I see that you've committed up since inception to the first quarter of 2013 1.26 billion across 136 funds representing 88 partnerships. Your net capital contributions came in at 800 million. Net distributions, capital coming back to you, came at 493 million. Market value of 591 million, which leaves you with a total value of about $1 billion. The total value multiple was 1.3 times, and a nice IRR of 10.2%. So if you turn to the next page, you'll see how the IRR is performing against the benchmarks. You'll see it came slightly under against the Russell 3000 plus 300 basis points, but significantly over against the Thompson 1 medium IRR, which came in at 3.8%. And if you turn to page 30, we'll take a look at the deals that we closed in during the quarter. So during the quarter, we closed in 3 investments, total 36 million, and they were in Landmark. Again, it's a secondary fund, Landmark 15, the Landmark Side co-investment fund that we had as well, and Acon Equity Partners 3, which was an emerging manager. Then subsequent to the quarter end, we closed in 7 other managers, 3 of which were core managers and the 4 of which were emerging managers, totaling $100 million. So if you turn to page 33, you'll see how the strategy is performing for you. So on the bottom table there, you'll see that the strategy that's performing the best for you is of the first quarter of 2013 was secondaries, leading with about 20.7% IRR, and that's really a function of great funds like Landmark, Lexington, and a new relationship, AXA, that we just brought in recently, or a couple of years ago. And then after that came in growth equity that came in at 19.3%, and that's really a function of great funds like Vista and Warburg Pincus, Warburg being a new relationship that we brought in. And then after that came in special situations, which had an IRR of 15.2%, and that's really a function of great funds like Platinum and Ares leading the funds there in terms of performance. And then at the end was buyout that came in at 12.2%, and you'll see from that subsector, the large buyouts are the ones that led the performance there at 26.7%. And that, again, are deals that we recently re-upped with, such as Apollo, Carlyle, and CVC, doing very well for your portfolio. And if you turn to page 37, this is where I'll leave off. Cash flows, the most important page, which shows the cash flow coming in and out. So you'll see the bottom bars there in that bar chart, the cash flows going out. The top, the lighter bars, are the cash flows coming in, which are your distributions. And you'll see for the first quarter you had a total distribution of 20.4 million. And then when you look at it against the previous first quarters for 2012 and 2011, doing significantly better. So all trending in a positive direction. And that's pretty much it for the first quarterly report for private equity.
Great. So moving on to real estate, there's a color handout in front of you. It's an executive summary for our first quarter report. New format. Take a look at it. Very interested to hear whether or not we can achieve our members. What we're really trying to do is make it a little bit more user-friendly and have a first page that at a glance told you quite a bit about your portfolio at your fingertips. In the following pages is a little bit more detail on portfolio construction, what's driving the performance in your portfolio, whether it's the non-core strategy or the core strategy, which manager it might be. There's also a market commentary that's in the back that's a little bit more global in perspective, and it also comments on how we are adjusting the portfolio to what's going on in the market. So just want to kind of give you some highlights on the portfolio, so I'm just going to stick to the first page. So with respect to real assets, there's a 5% allocation, as you know, for $460 million as of the first quarter of 2013. In terms of real estate, the market value of the real estate portfolio was approximately $325 million. We had some commitments outstanding that we have yet to fund, about $100 million. Altogether, our exposure to the real estate asset class is $425 million. And we have about 37 investments at this point, 28 managers. And in terms of the level of activity for the quarter, we had managers that were calling down capital of $13 million, while we had the more mature investments that were returning $8 million for the quarter. So let's talk about performance, and I want to direct your attention to the graph that's in the lower right of the first page. It shows the performance of the prior portfolio versus its benchmark, which is Odyssey plus 100 on an after-fee basis, and it depicts the performance over various time periods. As we look over to the right in the longer term periods, the portfolio went through a rough patch with the global financial crisis. But I'd like to point out that for the quarter, if you look over to the left, the quarter, and for the 1 year and for the 3 year, we're recovering nicely from the crisis, and the returns are quite strong against the benchmark. In terms of our investment activity, the first quarter we closed and committed 2 Sandy-related deals, and actually after the quarter we closed 2 other transactions, to KTR and to Emmons. So altogether, the first 2 quarters of this year, we closed on 4 deals at $30 million. We're going to be talking a little bit more about the portfolio in executive session, more in detail about manager and performance, but if there's any questions I can answer for you right now, and just bear in mind, looking for your feedback on this new format. Thank you.
Thanks. Martin, you want to go through the BSF? Or we can do that now. Do July and the IPS? Okay. So does everybody have their July books? Like so, like every month. So while you're looking, the bottom line of last fiscal year was a great fiscal year, about 12% return. The target is 7, so 500 basis points better. Well, I'll give you some more detail on that in the executive session. So let's skip all the economics and go page 34. So again, this is the first year of the first month of the new fiscal year. To put in context, in the middle of April, Ben Bernanke started talking about tapering, took the markets for surprise about interest rates going up. June was a mess. Had a good PR campaign in May and June, and sure enough, in July, everybody started to understand what Ben was talking about, and big rally in July. So if you look at the far left-hand side, the first block of numbers of the U.S. stock market basically was up 5 to 6%, and that's our biggest asset category, so that means we're going to have a good month. The next number is EFA, it's up 5%. Even emerging markets were up 1%. People rebalanced out of treasuries, so treasuries went down. And if you go all the way down to Citigroup, double B, and single B, the high yield market was up about 2%. So it's going to be a good month in July. If you go to page 30, as Martin mentioned, we've been over-allocated U.S. equities for the last 12 months. It's been the right thing to do. And we've been under-allocated U.S. governments and TIPS, also the right thing to do. We busted out of the ranges in July because, again, the U.S. stock market was up 5%. We figured it would come back down. Actually, in August, the U.S. stock market was down about 3%, so it rebalanced itself. But again, set up the same. We haven't done any active rebalancing. You go to page 36. What that meant was, in the month of July, we made over 3%. Don't annualize that number, don't get to 36%. But it's a good way to start the fiscal year, up 3%. As I mentioned, we gave some of that back in August, and then just to give you a sneak preview, September's been up, so we're probably back up around 3% midway through September. If you go to page 27, this is a rolling 12 months, and what you find at the end of July, we're at $9.4 billion, the highest value ever for FIRE. think we're pushing about 9.5 now, haven't gone down and back up. So again, I think we're at the highest amount of funding for the fire pension fund. If you go to page 28, you can see how it looks on a 10-year basis. The 10-year rate of return is 7.9% roughly, ahead of the 7% net, so things are looking okay. So that's July, first month, good way to start. I'd rather start fiscal year up 3% than down 3%. So that's July, August is down, September's back up. So that's July. Any questions on July? Great. So now, let's talk about the IPS. I'll have Catherine hand out 2 IPSs. One is marked. Alex, can you help her? One is marked for changes and one is black line. I'll let you get them before I give a couple of introductory remarks and have Catherine carry the ball. Thank you.
Good morning.
Ready?
Yep,
Okay.
I'm ready.
So, if you look at the first page of the IPS, it's dated, just the cover page, it's dated July 25th, 2007. That makes it technically 6 years old. The reality is the board has done a lot of different things in the last 6 years. Has done a new asset allocation, it's got new asset classes, has been very, very busy, as Catherine's going to walk you through. So we thought, rather than have an old IPS with lots of loose pieces of paper which people have in their files, we would conform the IPS and update it. Really no other changes than things that have already been approved by the board over the last 6 years, and give you a clean copy, which is this clean copy. And this has everything that the board has done in the last 6 years in one spot, as opposed to searching around in your files for where was the infrastructure IPS, for instance. It's all included. So, Catherine, you want to give a quick highlight?
Yeah. If you look on page 27, which is section 19 of the redlined copy, so that this is a list of everything that's been approved, and it reflects the changes that are made throughout the body of the IPS. So it's the most effective summary page. We've added some asset classes, that's reflected here, the large changes. We've changed asset allocation and rebalancing ranges in parking places. And there have been actually some legislative changes. Mr. North has changed the actuarial assumption, that's reflected here. Real estate can go up to 10% and not be in the basket clause. And we've approved new asset classes and new IPSs, and those are noted here. We did not, we emailed you the other IPSs, the opportunistic fixed income IPS, the real assets IPS, the hedge fund IPS. We did not print them for the sake of saving trees, because it's even more paper, but everything is reflected here. Any questions?
So again, there's no changes. It's just put it all in one document. You can have the document They need to hook it up with the appendices?
That's, yes, and we can send another email with everything when we're done here today, so everybody has it in
So you'll
one
get
place.
another email that has everything with the appendices, and then you can, that's the official IPS. So what we wanted, because there are word tweaks, what we'd like is the board to approve this new IPS, and then you can have it all in one spot. It's really for convenience more than anything else. Any questions?
Has the law department reviewed and provided you with its favorable opinion?
So, as we mentioned previously in another meeting, they did catch one of the mistakes we made vis-a-vis the securities litigation protocol, so I think you could reasonably infer they've seen it. We have not asked the law department, and in my time here, I don't believe we ever have, so we did not seek their opinion, and we're comfortable with what we put forth before you today.
I'm sorry, so is this the correct securities litigation protocol, or is there?
Yes, it
Yes.
It is, okay.
Absolutely.
All right. And did you provide this to NEPC in advance? And NEPC, have you had a chance to review?
Yeah, so we looked at this before we got the possibility. So, and we're in concurrence with the changes and the timeline.
I did note one change that was missing in the email copy that you sent to us. There was some language added to the real assets IPS in one of the sections. I believe it was, you don't have it here, so I'm sorry, I didn't print it out myself. But there was some language about the strategic objectives of the infrastructure program that didn't make its way into that document. And so,
Dennis, could you be more specific, because I'm unaware that there was any language that you say didn't make it into the document. If you could be more specific, we'd be happy to look at that.
yeah, I don't have it with me, but I can email it to you.
Okay. As I said, we're happy to look at it, but we're unaware that any language did not make it in.
To the best of my knowledge, everything that you got was reflected of changes that were approved as they were approved.
No, I can send it to you.
In fact, what happened with teachers with the same matter?
I'm sorry, Doug, I didn't hear you.
What happened with teachers with the same matter? This matter came before teachers, did it?
So we've had this before 2 boards, and 2 boards have accepted the motion made by the Controller's Office to accept the conforming changes, and that's what our goal is today here at Fire.
I'm not aware of 2 boards. I know it was adopted at one of the boards, but the other, it hasn't come before the teachers' board. They haven't met yet this month.
Well, I think, Janice, we don't need to get into it here with the governance of another board, but I think that there's a fundamental disagreement between folks as to how the governance works at that board, and I prefer not to sort of have that conversation here because I don't think it's fair to that board, but I believe that there's a view of how governance works at one board that I think you're in the minority on in that view, and I'll leave it at that.
Well, it's all on the public record, and it was videotaped. And it's a committee of the board, so it came before teachers because we sit on that board as well. And the teachers requested law department's review.
I don't think that's right at all.
I would respectfully disagree with that.
There was consensus at the board meeting, and it was approved at that board meeting. You should go look at the video then.
I will.
Okay. And it was approved at the police on Monday.
Yeah.
So teachers approved, police approved.
Yes. So,
Would you just hold a second? Go ahead, just- I'm sorry, I interrupted someone. I don't know what, maybe it was staff. Did I interrupt you?
No, Commissioner.
There's a motion.
So, Mr. Schloss,
yes.
I believe the request we have today is a motion to adopt the conforming IPS as presented, is that correct?
Yes, I just made that motion.
Oh, I'm sorry, Mr. Rookton, I apologize.
No.
Any objection? All in favor?
Aye.
All against?
Nay.
Nay? Any objections? Well, the ayes have it.
Thank you. That ends our agenda for the pension fund public session.
Can I just ask a question before we move out of public session? May I ask a question?
Sure.
So, can you just give us an update on the ETI program now that Kathy Martino has left? Who's doing what with regard to the program? What is BAM responsible for? What is the Comptroller's Bureau of Economic Development responsible for?
Sure. As you know, there are different bureaus inside the Comptroller's office, one of which is the Bureau of Asset Management, which is the advisor to all the pension funds. Another bureau is the Bureau of Economic Development. The Bureau of Economic Development's charter, although I don't know if it's official charter, mandate, is to find things that can help New York City grow. And what they tend to do is look for investment opportunities for us, and they're out in the market. And if they find anything, the Bureau of Asset Management does investment analysis with the appropriate consultant, be it real estate, private equity, or general consultant, brings matters to the board from time to time for approval of the board. The person who is in charge of it depends by asset class who's in charge of what assets that the economic development people come up with. So if it's real estate, the real estate people, Yvonne looks at it. If it's fixed income, Martin looks at it. Most of them to date have been fixed income, so Martin has reviewed them all and brought them all to the boards. So, and Kathy Martino was a valued employee of the city for 20 plus years, and she retired in August. Is that helpful?
And so exactly what is the, David, sorry, I didn't.
Morris.
And the new fellow, I didn't catch his name.
Yeah.
Chris Pack. So what specifically is their role with regard to the investments? Because they were providing us with a performance review, but it sounds like BAM is really the group that's responsible.
It was his first time here. He felt like talking about performance.
Okay.
I'll work on his script so he just talks about economic development.
Okay. So they're merely providing sourcing and presenting BAM with opportunities.
Yeah. They're in the market. If they can find something that we can look at, that's great. Because again, you know, the city's big, complicated, hard to know who should show us things. So we have people that are out in the market trying to say, hey, that might be an interesting investment opportunity. And that's as far as it goes. Again, they work very well with our consultants, with real estate consultants in particular, as well as NEPC. A bunch of the investment plans that have come about over the years, I think, came from the Bureau of Economic Development working with BAM. And at one point in the history, there wasn't the Bureau of Economic Development, it was all inside BAM. It's an additional feet on the street, and it's very good resources.
So Chris and David, you don't envision them being part of the due diligence and the decision-making
No.
team?
No, not at all.
Thanks.
Sure.
Is that it for this section? All right.
Yes, that's it. So I need a motion to adjourn the public session of the pension fund to get to the PCF.
We're going to move into firefighter variable supplement, right?
Yeah. Martin?
We need a motion to move out of the public session. Did you make a motion?
Second.
Any objections? Hearing none, the motion carries. Okay, so we're going to start the firefighter variable supplement fund. We need a roll call.
And you also add to the motion to close the meeting because it's another meeting. Ms. Janice Emery?
Here.
Mr. Larry Ross?
Here.
Mr. James Levin?
Here.
Mr. Robert Croft?
Here.
We have to vote on his meeting.
Was there any questions
We reviewed the reports and we find it satisfactory, so we have no questions at this time.
Any other comments?
So I think we need a motion to close the variable supplement. Firefighter variable supplement, move it to our next week's meeting.
So moved.
Any objections? Hearing none, motion carried. We're now going to move into the fire officer's variable supplement fund meeting. We need a roll call.
Ms. Janice Allen,
Here.
Mr. Larry Schloss,
There.
Mr. James McGowan,
Yeah.
Mr. James Lamanda,
John Farina has James and Margaret first.
the full votes, we can start a meeting.
We
Yeah.
distributed
We
the
have-
reports ahead of time. Are there any questions?
No. No questions whatsoever. We reviewed the document and we have no questions.
Okay, so we now need a motion to close the public meeting, fire officer's variable supplement fund and move into executive session.
So moved.
Second.
Any objections? Hearing none, motion carries. We now